This is a follow-up to my last two videos. So I posted how my private portfolio is doing against some benchmarks. I then showed how to calculate those numbers. So in this video, I'm going to cover kind of my investment plan for the next 6 years. So the first thing, if you guys watch those videos, is my non-retirement portfolio is pretty heavy in actual houses. Okay, so that I'm not going to buy any more houses. All right. And I'll show you why here. Uh, okay. So here's the same sheet I showed in my last video. This is just a chart of my best performing property, 60% internal rate of return, which is insane, right? This incorporates cash flows, taxes, my refinance, everything. So we can see, we have my aggregate cash here. So I wasn't actually cash flow positive until I refinanced, right? I might, if I hadn't been able to refinance, now be cash flow positive. But what that means is, I paid 10 grand for that property. And if I didn't have a chance to refinance, I was actually negative, right? So if I kept that 10 grand, I could have had that in something else that got me cash back a little bit faster. And then you see this value here just skyrocketed, right? The value of the house basically 2x, 60% IRR. So what I did, the average appreciation of homes is 3 to 5% in this area. Mine was a lot higher than that. I think it was over 25%, just, because of everything with the market. So check out this chart. This is if my property was appreciating at 3% year over year. So my IRR is about half, right? We can see that I never am cash flow positive, right? That would mean I paid 10 grand for this. And then I'm getting cash flow, every month, whatever, I make, whatever this looks like, about $1,000 over the course of 2 years, another probably 1,500, another 1,500, and then bam, my tenants turned over. I lost 3 grand, right? So almost all that cash flow was gone. So that's why, I have some other videos if you're interested, but the fact that owning single homes is a good idea for cash flow is a fallacy. All right. That comes from people who aren't looking at actuals. That comes from people who are looking at pro formas, right? Because if anyone who owns an actual house knows that every couple years the cost to turnover, all right, is going to crush your cash flow. The other thing not depicted here is the fact that I probably have tons of deferred maintenance on that house, right? I should be accounting for the roof. That is in some deprecated state that's going to need repaired. Every major appliance, every major facet of that home is in some deprecated state of repair. So that's not reflected here either. That would be reflected when I sell. You know, then the other thing here, so I get about 30 grand in equity. That's mostly from principal pay down. So I got about 15 grand, 3% year over year in appreciation. The other 15 was principal pay down. So that's how I got my equity. But so anyways, 30% IRR is still pretty good, but that was about half, right? And this property was insane, right? This is one of the best deals I've ever seen. There are almost no repairs on this thing except for that 1 year. You saw in 6 years it wasn't cash flow positive, right? Unless I refinanced, which if the market, is what it historically has been, you're not going to be able to refinance in the timeline that I did. So my other property is going to now be below about 20%, which is my threshold. So I had bought a bunch of properties. I'm not going to do that anymore. So I just wanted to give you guys a quick rundown of kind of what I think people should be doing. What you should be doing are low risk things that generate cash, right? Think outside the box. So what I'm doing, the lowest risk thing that generates cash for me is house hacking. So we bought a house, we're living in it, we're flipping it into a vacation rental, and we're filing a lease as a real estate professional. So that's a big tax strategy. So why is that generating cash? It's generating about 30, 40 grand for me a year in tax savings, right? Because now, since this is a business and we rent it out, I can file her as a real estate professional. I can get a cost segregation on this thing. I can deduct a crap load against my W-2. So that is guaranteed income here. Okay, so that's why basically all my W-2 cash is going into flipping this thing that'll then, produce cash flow for us when we're done. The other thing is starting a business, right? Is I'm looking to generate cash from a business, all right, not necessarily investments. Um, so with my existing portfolio and the cash I'm generating from a business, I'm putting as much as I can into a different retirement account. Okay, I guess not depicted here is I have my self-directed IRA over here already. My self-directed IRA over here. So I'm putting all of this cash into low risk funds, right? So all the cash I generate from my side business in a solo 401k, putting those as a passive investor in funds, right? No longer buying houses. These are a large portfolio of funds is going to have less risk than a single house. Excess cash flow from my existing portfolio, aggregating that into a fund, and then my self-directed IRA. So what I'm looking at here are things that are cash flowing already. Okay, so not big builds. So I've been talking to a lot of equity groups and a lot of operators, and the people with the highest IRRs in the last 10 years were the builders, right? Why do you think that is? It was due to the market, where rents are going through the roof, prices are going through the roof. So it was a good time to be a builder. I have no interest in that for at least the next couple years, just due to the risk. So I'm not looking at major construction. I'm looking for things that is already cash flowing, and we're basically coming in and adding some value. So I invested in a industrial facility that's housing a business where the facility was already there, and the owner was just basically looking to get his cash back. So that owner de-risked that investment for his LPs. And I'm also looking at some mobile home parks, which already exist, and they're basically just owners that want to get out of the business, don't want to operate anymore. So we can come in, buy that mobile home park, fix it up, put management in place, and get some really quick increase in operational margin, which is going to increase the value. I'm also looking at areas in the Midwest. So Florida and Texas were really popular in the last couple of years. The rent to price ratio there is now starting to tip in a way that's not favorable. So I'm now looking back at areas with a more favorable rent to price ratio, which you want a higher ratio. You want to be able to get higher rents for the price. So I'm looking back in your typical Midwest areas, and like I said again, really low risk, right? I just don't want to lose money. So when I see a deal that I'm confident in that's at least 20% IRR, I like that a lot, right? I like that a lot more than something like a projected 35% IRR, which I saw, but it was a build, right? It was construction. I will take that 20% IRR on an existing facility that's already cash flowing every day because the risk is way, way lower. So anyways, guys, this is the last video in the series. That's a quick overview of what I'm looking at for the next 6 years and why. So if anyone's interested in chatting about this stuff, I love this stuff. If you disagree with anything I say, I would love to talk to you. You know what I mean? Because like I said, my passion is finding the best opportunities. And that's because, I want to help, the people that are really important to me, either other veterans or other people in the working class. I'd love to just continue to collaborate with anyone, work together, and just make a shitload of money. You know what I mean? It's not that hard if you get connected with the right people. It doesn't take a lot of time. So I hope you enjoyed. Let me know if anyone has questions.